All right, guys, welcome. We are live. It is it is Thursday, September 12th, 2024. Right now, markets are performing pretty good. I think they're all bracing and embracing the expected rate reduction of 25 basis points coming next week. I think if we see something better than 25 basis points, I think the markets will rally. I think 25 basis points, we're probably going to see truthfully, we'll probably see a small rally and possibly even a sorry, my cat, and possibly even a small correction because it's so priced in that people will be taking profits. So, yeah, long story short, let's jump in. Pretty much the two main things or the three main things I want to cover today are are the following. I want to go over what open positions we have. Number two, I want to specifically cover the INTU uh, position a little bit closer and kind of tell you a little bit more about what the poor man covered call strategy looks like. TJ the Wheel Deal does a really good job at explaining it. I've started to incorporate it into my portfolio, a small amount. I have close to 200. I maybe spend 4 to 5,000 on the high end. So that's about 2% of my portfolio is in poor man covered call, 2.5%. So it's not a big amount, but I think it's an important strategy. And once you look at it on a return basis, it's the returns on a percentage are astronomical. If you've been following this channel, we did it with Melly, which is the Amazon of Latin America. We used it to essentially reduce our cost basis while we waited for earnings. Right after earnings, it shot up. We ended up making, I think it was a 30 or 40% return in 2 weeks. Best case scenario. So, that's pretty much what we'll cover. And then the third thing I want to talk about is taking profits and sort of a small strategy that I've developed, which I've been having a lot of success with that I want to share with you all. And we'll kind of get into that one as well. So right now, we'll look at year to date, close to 60,000, we're nearing up on a 40% return. The majority of my money is in Tesla. I bought Tesla when it was in the I think when it started to go down a couple months ago, started buying in the 180s, 190s. I think I even bought some in the 160s. So my average is 173, 174. So right now I'm wheeling, and I'll get into that Tesla position one of these days. I'll do a real deep dive into the thought process behind it. But right now it's a pretty dormant position. I'm in a very profitable position as far as my covered calls being underwater, right? Because there's still, even though 205 is, and they're all the way to December, if I look at what these, even though I'm underwater, right? If I look at what my return, and again, it's important not to get greedy, right? There's two ways to look at it. I can look at it and say, damn, till December, I'm losing all upside from 205 upwards, which is true. Once December comes around, I can roll it out, which is fine. But the other way to look at this trade is I am collecting so much premium from now until December that I believe it's going to add another $15,000. I think I've already collected about 15. There's about 42,000 left, if I'm not mistaken, of which I believe 15 is intrinsic value, which means that time decays on my side, right? And if we go to simulate my returns, right now it's just assuming a price of 229, which is where it's at now, which honestly anything above the 205 should garner the same result. But the closer we get, I still have, so to date, I've already made the 14,000. But even if it's, when we go all the way to 0 days till expiration, that's 30. So that's an additional 15,000. Now you see the estimated contract price. That's pretty much 100% extrinsic value. So that's the difference between my strike, which is 205, and the current price, which is 229. So if I add $24 to 205, it gives me about 229.48, which is where it's at right now. So this is purely extrinsic value. So my point is that if I look at $15,000 divided by what my basis is for those 800 shares, it's a pretty decent. I mean, let's do it. Let's just do the quick math right now. So if I paid 17,300 per 100 contracts, and that's 800, and that's 8 contracts, so that's 138,400. So 15,000 divided by 138 and change is 11%. So all I have to do is sit pretty for the next October, November, December, for the next 3 months to make 11%. And I have downside protection. So if Tesla comes down from 230 to 205, I'm good. It doesn't really affect me. Now, if it goes below 205, then that's where, and nothing's changed fundamentally, then that's where I really start squeezing the premiums, and it's even more of a win-win. So anyways, let's get back to it. Let's start with doing a quick portfolio review. Portfolio is reaching all-time highs right now. We are at 205, getting to 205. Just this week, I believe, we're closing in on the 2% in the week. So my main positions right now, we have a few positions on CleanSpark. Last week or earlier this week, it had a pretty big drawdown. Remember, these Bitcoin miners are very, very related to how the Bitcoin price is doing, because a lot of these, they sell them or they keep the Bitcoin price, so it drastically affects their balance sheets or what they can sell them for. So Bitcoin influences these companies a lot. So just keep that in mind. It's a lot of exposure. So right now I have this position open. CleanSpark's at $9.35. Now I got caught with CleanSpark, right? I had, right when it was at $17, I had sold some puts. And luckily, based on all the premiums, my basis is around $13. So right now I'm just wheeling it, selling puts on it. I'm not opposed to holding the shares. I have a pretty bullish outlook with Bitcoin. So right now I'm wheeling it, right? So if we go into here, it's going to show you my basis, 1585. It's a little bit lower than this because I've been selling calls and puts on it. But right now I have two 950 calls, which are probably going to expire worthless. Now we're at 935. $10 calls, probably going to expire worthless. And then I have these $8.50 puts, which are so far out of the money that, I'm not even concerned, right? And I sold these contracts 53. So I sold these September 10th, so 2 days ago, right? And so what I want to tell you guys is strategy, and we'll continue going through the positions that I have open. But the strategy that I want to highlight with you guys is it's the strategy of taking profits, right? And especially with tickers like CleanSpark and Riot, which are these companies are very volatile. I mean, just in 1 week, we're going from we're going from $8 to $9.50 in 1 week, and the reality is that, sure, we have rate hikes coming in next week, but the reality is that this could easily tank as well. We don't know how Bitcoin is going to react to these rate reductions. For all we know, maybe there's an outflow of capital from Bitcoin into the markets because now that rates are down, there's a bullish sentiment back in the market, right? So my point is that when you see profits, right now we're at 40% profits. You don't necessarily have to take off all your chips. You can let some of them run, but don't be afraid to lock in some profits. And so what I like to do is, we have 5 contracts here, right? And we're already up 40% on them. So probably what I'll do with this one with CleanSpark is I'm going to go ahead to close, nothing crazy either. And again, we're talking of small position on my end, five contracts, nothing crazy. but this is scalable to any portion. You know, if you have 1,000 contracts, close 300 of them. Lock in that profit. Don't be afraid to lock in that profit. And so what I always do is, if I like the trade, I like the strikes, and I like the expiration date, which I do, because remember, this is still, look at this. We're making 40% of this premium, right? We sold these on, well, we sold one of these on the 10th. So look, that actually it speaks to my point, which is I had opened these September 3rd at 53. By September 10th, they were still trading at the same amount. So what's to say that tomorrow it tanks and we're back to 53 on that contract? So what I like to do is I like to go ahead and lock in some profits. So I'm going to go over here. I'm actually going to lock in, you know what, let's lock in 3. Let's not go too crazy, not lock in 4. But I always like to leave 1 or 2 or a small bit. If I like to, again, if I like the trade, I like the strike, I like the expiration date, right? I like the stock. I'm still bullish on it. What I'm going to do is I'm just going to go ahead and close 3 of them, maybe even 4 of them, and leave the other 2 open so I can keep track of that trade and also remember my basis. Because if CleanSpark decides to come back down again and this premium spikes to higher than 53, I'm going to rebuy them. I'm going to rebuy 3 or 4 of them, you know, and then guess what? When CleanSpark rallies again, and it's again at 40% or 50%, I'm going to go ahead and sell 3 and 4. And I just continually do that until either the, you see, the thing is with these stocks that are so volatile, it almost always makes sense to do that. I don't suggest day trading, because if it's not going your way, you just let it ride. Or if the premium hasn't changed that much, you just let it ride. But with these stocks that are so volatile, it almost always makes sense to do that, you know. And so let's go ahead and lock this in. You know, we're going to be paying 128 to release 4 contracts. Now let's see if we get filled here. It should get filled right now because this just went up 626. Let's see if this goes to 635, we'll probably get filled. Huh, 636. Come on, 636. So we're just waiting for this to get filled here, but I don't. So one way to really see what they're getting filled at is you go down here to the stats and you look at what the last trade was, right? So the last amount that somebody paid for this was 31. Now that's not to say that that's what you'll get, but at least you know what the last amount was that somebody paid. Right now there's a lot of people saying they want 33, and not that many people saying that they'll pay 32. So when I say 32 here, you know, we just got to be patient and wait for this to get locked in. So, but look, at the end of the day, don't get greedy either. You know, if it's not filling in, let's just go up 1 here. Oh, it's up 31, 32 now. Did I read that right? All right, so we got filled at 33. You know, so what is that? 53 minus 33, that's 20 bucks, right? So we just made 20 bucks times 4 is $80. So we just locked in 80 bucks right here on $850 of collateral. Let's see what that comes out to. That's a two, that's almost a 2.5% return. 2.5% return. You see, so that's why it's like you. This is an episode. This is a completely different episode, and I've covered this many times. But that's why it's so important to track your trades, because when you get down to the percentages, a lot of these trades, $20, you look at it and you're like, wow, what am I going to do with $20, dude? $20 is 2.5% on your money. If I was to buy more of these contracts, and let's say buy 1,000 contracts like TJ does, 2.5% on your money in a week's time is incredible, considering the government's paying you 5 for the whole year, right? So obviously there's risk with these miners. I'm not saying that it's the same type of investment, but you have to be realistic and don't get greedy, right? So take profits. I just locked in a 2.5% return, right? And what I'm going to do is I'm going to leave this one contract open. And if this thing comes back up to maybe 40 or 50, guess what? I'm going to reopen 4 more or maybe 9 more and have a 10. And then if it goes back up, I'll close another 5 and just continue doing that until you have to either open up a new trade, right? Because I like this trade so much. So that's my point. My point is take profits. There's nothing wrong with taking profits. So right here, we've got these 2 calls open, nothing going on there. Intuit, I'll leave that for the end so we can kind of go through it. Riot, this is my other miner. They're kind of going through a bit of a turbulent time, but it seems they're trying to acquire another Bitcoin miner. It seems like that other Bitcoin miner has kind of said, you know what, let's go to the table and negotiate, which is great news. I expect this thing to go through the roof as soon as that's finalized. Let's go through Riot. So I actually don't own any Riot shares, which is great because I try to really not to. I don't like to own miners; they're very volatile. But it was so cheap that I had to purchase some. So, or rather, sell puts on it. So I sold. I actually got caught on the way down. So right now it's at 709. I sold some 750s. This is sort of an advanced strategy, which is where you sell puts in the money if you expect it to go up in the future. So I probably sold these when it was still trading below 750. Um, Obviously, I don't intend to get assigned, and you have to be careful that you don't get assigned. But that's why the premium is so juicy, right? So even though I'm still way under the strike and I'm in the money, I'm already up 22% on this trade, $250, right? I collected $75 of premium per put. I mean, let's just do the math again. I mean, it gets kind of crazy at some points, but $75 divided by 750, you're looking at a 10% return. So even if I try to trade, if I close this trade right now, right, which would get me, what is that? 75 minus 58, which is what I would have to buy it back at. That's a 2.26% return. So even if I closed it out right now, I would get a 2.5% return, right? And I believe with this particular, there's one that I've been rolling, and you have to keep track of your rolls. 5278, sell. See, I have different, and this is something Robinhood's not great at, which is your lots. I wish I could select which lots to pair my sells with, but because I believe Robinhood does first in, first out, so if you sell it, it'll assign it to the first in. So that means that if I was to sell right now at 58 or buy them back at 58, it would log a loss because I bought these at 52, right? And I don't really want to log in a loss. So I'm probably going to wait till these get lower than 52. Again, I'm bullish on Riot, but I will probably wait just to get a win because again, I wouldn't even be able to use that loss, once you get into the whole wash rules where you have to wait 30 days to initiate another trade with the same ticker. If you want to use that loss to offset your gains, I don't believe I'd be able to do that because obviously this trade is expiring on 9/20, right? And I'm already trading Riot. I so that's it's just something to keep in mind. That's why I haven't done it. I still have 15, but otherwise I would have started closing. I mean, I have 15, maybe I'd close 5, and lock in that win. So um, that's sort of where we're at with this. Good trade. Riot. I've got a $7 put. So this actually is exactly what we just talked about. I only have one left to kind of track it. $22 credit that expires tomorrow. So obviously it's doing good. $7. It's close. I just bought these back 6 hours ago this morning for 15. So I still, you don't always, you can't get greedy. I think that's just the bottom line. You can't get greedy, right? 15. I had sold them for 22. So I locked in, $7 of premium times 4, 28, 30 bucks, whatever. I'll probably let this one expire tomorrow worthless. So then my average goes up because now I collected, 22 plus, or rather 0. So now it's really dividing that 15 by the 5 if I let this one expire by 0, right? So 15, if I pay 15 times 4, I paid 60 bucks. But if I divide it by 5, it goes down to 12. So technically, I paid 12 bucks instead of 15. If I let, you see what I'm saying? So you start playing a little bit with the averages to manufacture the win. That's really what it comes down to. So it's just a little strategy. I've got 25 cells here for $7. And this one expires on the 20th, and I got $41. So you see, this is a trade where maybe what I'll do, and I think if I'm not mistaken, this is the one that I may have rolled it, if I'm not mistaken. No, I think this is just, I think this one I just sold. So, this one's a $7 put. I like this trade a lot, actually, and I have 25. So maybe what I'll do is I'm going to close, I'm going to close maybe 5 of them. Or you know what, I'm going to close 10 of these, and lock in a trade and lock in a win. What are the bases that I bought this 5 at 29, 2 at 32, 3 at 30, 5 at 48, 5 at 56, 5 at 45. So first in, first out, first one's going to be 29, 2 at 32 and 30. So yeah, I'll probably sell 10. So at least I can actually lock in a gain, because this is probably going to be a wash on this one. And then these two, I'll do a small profit on these two. Take some risk off the table. So let's do buy to close. Let's do 10 contracts at 28. I don't know if that's going to fill or not, but we want to do it at 28. And you know what? If it doesn't fill, I'm honestly okay holding on to this. This is pretty much the premium that I sold them at originally. It's just that I averaged up as it kept going lower. And I averaged up to $41 in premium. But in reality, 29 is what I got them at. So this would just be getting out of the trade and leaving the rest as gravy. So let's see if 28 gets filled. But you know what? Might as well just ride it. We already have enough risk off the table on Riot. Let's see. All right, so we covered Riot. Let's go into, what else do we have here? Amazon. So this Amazon play is sort of like this Portman coverage call gone bad. But again, the key with the Portman coverage call, and I'll get into it in detail when we cover into it, is you got to really buy them out. You got to buy leaps, and I'll tell you why. Because with the leaps, it allows you enough time to roll out on your short leg to really lock in that profit on premiums that's going to offset your call price. That's the key right there, right? Especially if the stock price is underwater or under the price of your long call, which you got to be really careful on. And Intuit has been a perfect example of that. Riot, we covered Riot. SoFi, SoFi's been just a money-making machine. I mean, this thing is just, it's been bouncing around like basically between 650 and 750, maybe 8, but it's just been bouncing around for the past couple months. And you know how to profit off it. You can make some good money on it. Right now I have some $750 puts, which, you know, what did we sell these at? 63. So I sold these in the money. We're up $600 on these, 20. Did I roll these out? Yeah, these are rolled out. So I'd have to look at my spreadsheet to see what my basis is on these. But I think my basis on these is about $20, $24, or $28. So right now I'm finally starting to make profit. So this, don't be fooled. This is not really a profit. This is just me regaining what I lost on rolling the other two. I'm going to let these ones ride. I think SoFi is going to perform very well with the rate reductions. So we'll let that kind of play out. $7 put, I got one sell here. I'm just keeping an eye on this one. I took a profit on it. SoFi, $6.50 puts. This one is just really a no-brainer. I bought a few of them, 5 contracts, sold them at 20, bought them 5 at 11. So I locked in a 50% profit. Probably going to let these just ride out. There's a lot of time left though, 10-4, almost, what is that, 10-4? It's like a little bit less than a month. And there's only $40 left of premium on here. So all that's telling me is $40 for 6. So if we were to do $40, right, divided by 650 times 4. How many contracts are I? 5. 650 times 5 times 100. The question is, it's a percent, 1.23%. So it's, do I want to keep this money locked in for 1% return? It depends on what your answer is, and it depends the money that you're using, right? Or what money you're using. This is money on margin. So this is really a free money. It's a free 1.5% return. And when you're trading with margin, you really want to make sure you trade on these low delta, very safe trades, right? Because you don't want to put that margin money on any sort of risk. And so for that reason, I'm going to let this trade just run. SoFi, January 25 calls. These are calls that I just had rolled out. SoFi, $7 calls for January. Rolled these out. I've gotten caught underwater. I did the math on both of these. It's like a 15% return, just waiting until January. Let them get called away if need be, but just on premium wise. So, I said, you know what? If anything, I will let either these or these or these get assigned and just start wheeling those. But I'm not concerned with SoFi. You see, a lot of these trades, as you can notice, I win either way. Whether it goes up or it goes down, I win. And so that's why it's important to collect profits, because when you're winning, you collect profits. When a stock is up, you collect profits on your puts and you sell your calls. When the stock comes down, you collect profit on your calls and you open up more puts. And you just do this as it goes up and down. I mean, you're literally profiting off the volatility of the stock. And it's a beautiful thing. Tesla, I've got this T. So I've got two, apart from my normal 1,000 share position, I've got two open positions on Tesla. So I've got these credit put spreads. These, I usually try to stay away from credit spreads because they're very dangerous. And if you ever intend to open up credit spreads, if you look at it on a percent return on collateral, they're very attractive. The percents are ridiculous. But if you get caught underwater with these credit spreads, it can be very devastating unless you have the funds to dismantle the trade. And what I mean by dismantle the trade is a spread is comprised of you buy a put and then you sell a put, right? So if Tesla ever does go down to 170, the one that I bought is probably going to be worth a lot, and the one that you sold is not going to be worth a lot, right? So your max loss is pretty much the difference between these two. So it's $1,000. But what people don't really tell you is that, you know, if Tesla goes down to 160, right? Or I'm sorry, you sold a 170 put. So that means that anything below 170 is not covered until the 160 kicks in. But if it doesn't get to the 160, then that put that you bought is going to expire worthless, and your risk is going to be really the extrinsic value of that 170 put. My point is that the exposure that you have is not great, but if you have the funds to dismantle it, you do it. So how would you dismantle it? I would sell the put that I had bought, which is going to be worth a lot of money, and then I would have cash to secure this put and then roll it down if it continues to go down. That's how you dismantle the credit spread. But what I've been doing with these credit spreads is pretty much what I've been teaching you guys as far as just taking profits. I think at one point I had 10 of these open. I opened these up at 223, and I've just been taking profits ever since. You know, I close them up when Tesla spikes. I reopen them when it comes down. You know, like right here, I what is this one? I closed this one for 150. I closed three of these. Where is this? For 205. Closed this one for 170. You know, and as Tesla keeps going up and these keep going down in price, I just sell these out, right? Because my basis is 223. So even if I look at it on a percent, again, these are all the way till December. So that's why I keep one open to just keep tabs on the position, and reopen it if it comes down again for some reason, if Tesla comes down. So if I look at it on a return basis, right, if I collected $223 and it's worth 150 now, that's $73. But this only requires $1,000 of collateral. So if I look at it on $73 on 1,000, that's a 7.5% return, right? So 7.5% return is, I mean, you're already beating treasuries, you know, and what are the odds that Tesla goes from 230 to 170? You know, what are the odds? So that is a position I have open. And then I had some TSLL calls that I basically did the same strategy. I bought about 10 options, a little bit riskier because I didn't sell covered calls on them. It wasn't a poor man's covered call. This was just a straight out buy. Very small amount. I think I spent like a total of $3,000. I sold them for like 4,000. I made like $800 or $900 on them. But if you look at it percent return wise, it was very attractive. These are long term, you know, $7 puts. TSLL is at $11. So this is pretty much just pure theta decay. You know, like just let this baby melt pretty much. You know, basically what I'm looking at is by my birthday, November 17th, I would have made already $840 on this, right? So 840 plus 280, I don't have to touch this trade and I'm going to be making $500, right? And if you look at it on a return basis, you know, $7. So 7 times 100 is 700, and we collected $100 per credit, right? You're talking $100 on 700. That's a little bit under, I believe, 10%. No, it's 14%. That's a 14% return, right? 14% return for this is a phenomenal trade. So this is just something I'm just letting it ride. I'm not really concerned on this one. Now all right, so that's pretty much all the positions that I have, okay? I have Tesla, Palantir, 100 shares, SoFi. Palantir, I'm not really sure what to do with it yet. I don't know if to just let it get called away. Probably what I'll do, just to minimize my tax implications, is right now I have a $28 call on it. So I'll probably just push it out to January and try to bring it up as high as I can. I think I don't think this is any sort of mystery, and we were actually talking about it yesterday with TJ the Wheel Deal and Bill White. And I think it's no secret that Palantir is overvalued. I think there's been a lot of momentum behind the stock, and so because of that, it's reached these heights. And so I want to collect all that premium, right? So I'll probably roll this out to like maybe 32 or 31, and just wait and let it ride. I also sold $28 puts for next week, the 27th. Collected $50 here, so you know, $56 on 2,800 is not that great, but hey, you can't win them all or make them all look so sexy. 56 bucks on 2,800 bucks, you're looking at a 2% return. I'll do a 2% return. And the beautiful thing is that, this is called sandwiching your trade. But when you sandwich your trade, it pretty much just means that I'm going to win either one. Either it's above 28 and these puts print, or it's below 28 and I collect all this premium. I have $439 of premium here, which it's been from rolling as well. So I love doing that. That's a strategy I use all the time. Sandwich your trades. Put yourself in a position where you're guaranteed to win. And that's the beauty with options, is that you're really just positioning yourself to win from the volatility. That's it. That's the game. So I'm using pretty much a lot of margin. I have about 5 or 6,000 in cash. Not using all of my margin. I try to block it out because I really, it says I have 12,000 buying power, but in reality, it's more like, if I was to remove the borrowing limit, it's closer to like 60 maybe. Yeah, and you have to be very diligent with your margin, because first of all, you don't want to pay for margin ever. But number two, just remember it's borrowed money, and you don't want to owe anybody anything. So um, just make sure that whatever you trades you use margin for are trades that are very, very low risk. All right, so let's talk about Intuit, right? So Intuit has been interesting because yesterday I did a little maneuvering. I had sold some pretty aggressive calls on them. So I went ahead and bought calls. I bought a few Intuit calls. I think Intuit's undervalued right now. They're a phenomenal company. They have a huge moat. I think they are doing some changes on their business model to subscription based. It's a great company. They did phenomenal with their earnings. They beat earnings. And so I said, you know what, I'm going to go ahead and buy some calls on it and do a poor man's covered call. So I bought 3 645 calls. I'm sorry, 4 690 calls. I had already owned one, which I think I covered that story, but I bought one for like $2,500 right before earnings, and now they're worth like 400. So I've luckily been able to sell cover calls on that enough to now my basis is lower than what they're at right now. So I'm profitable on the trade, but it was one that just didn't go the way it was supposed to, and you save them by selling calls on it. So long story short, got 4 calls here. I did a specific debit strategy here. So debit means that I actually paid for this trade. And the reason why I paid for this trade is because the long dated call was very expensive. So it's a December 690 call. The other ones are October. So this is like a $2,000 call. Actually, right now it's probably worth a lot more. Right now it's probably worth $600-700 more. I paid $1,600 for it. It's worth $2,000. But here's the key. I'm throttled by this 635 call, right? The 635 call is underwater. Intuit is at 642. Luckily, I have time. I have till 9:20. But this is the game you play with poor man's covered call, because you don't want to be underwater. And number two, you don't ever want these to be in a position where they're going to get called away. Because if this gets called away, then my other one gets called away, and I lose all the extrinsic value that I have, that I paid for, right? So a good chunk of that call is going to be a loss. So that's why I usually sell them out 2 weeks. There's less chance that they get assigned. And you just got to keep an eye on them. And so the idea here is that because the long dated call that this is paired with expires in December, I have the ability to roll this one until hopefully I'm either above the strike of the other one, or I'm in a position where I get to a point where I actually beat the strike price or the share price, and I have the opportunity to just let those calls expire worthless, so that the call that I bought uh, is not affected or tied to any calls, and I can choose to either sell it at its increased price or just sell another call on it, right? So you always want to be above the share price. So this one, given it's at 635 and into it's at 642, I'm going to be patient with it because Intuit, and this is the beautiful thing about riding the stock, right? You pick your horse, is that you become very familiar to the way that it moves and the way that it reacts, right? Intuit, for example, in the past 3-4 weeks, hasn't reached 642. It would always reach 630, 635. So two things are going to happen. It's either going to continue going up, right? All-time highs are in the 670, 680, 690. So it's going to have a lot of momentum, and it probably won't do that until earnings, or it's going to just resort back to the 620, 630 range and stay there. So that's why I haven't rolled this position out yet. But if I was concerned about this position, what I would do is I would, you see, and it doesn't even give me the option to roll it because it's looking at it as a, let's see, view all options. So right now I have the, here, let's do it with one that does show us the roll, just so we can, so I can show you a little bit better. So for example, this one, right? 645. This is one that expires tomorrow. I rolled these other 645 to next week, and I rolled them up because I was at 632, 635. This 645 here, right? Very cutting it very close, 643. Depending on what happens tomorrow, I may or may not roll it in the morning. If Intuit is green tomorrow, I may roll this out. But here's what I would do. So right now, this has probably lost a lot of money. I got 194. It is worth 390 right now. This is going to continue just bleeding money until tomorrow because the theta is going to accelerate as we get to expiration date. But if I want to, what I can do is, because I have so much time on my long call, I can just choose one more week, right, till next week, and roll it up to, right now it's worth 370. So even if I want to roll it for a credit, right, so I just continue making money, I can go all the way up to 660 and still make money and make 80 bucks on it. So that's almost, I don't want to say guaranteed, but it's a pretty damn good chance that I'm going to be above the share price by 920. And remember, because my long calls are for October 18, I would still have a month left on these calls, and I would probably just sell them out. So let's see this 635. It doesn't even let me roll it because it's tied. I'm not a fan of that, and I really wish it just expires worthless. So that way I don't have to do this manually and just buy the close and reopen one. But you know, we'll cross that bridge when we get there. Look, and that's pretty much it, guys. Those are all the positions that we have right now. Oh, I see TJ's on here. Damn, I missed TJ. I missed TJ. Damn. Let's see what you pop on there. Let's see. One of these days we're gonna get TJ on here. I think he may have already. I think he may have already stepped aside. I don't know if he's still TJ. If you're there, man, let me know and I'll share the link here so anybody can join. Actually, you know what? Let me just share the link. Let me see if I can figure out how to do this. Invite, copy. All right, I'm gonna post the link on Twitter. So you guys go to Twitter, And if you have any questions, anything you want to look at, I'm more than happy to go through it, give you my opinion. Obviously, it's 100% your decision, and I say that only because you got to own your trades. The moment you own your trades, you can grow from them, and if you grow from them, you don't make that mistake again. So I will give you my opinion. I'm putting the link on X right under the link of this. So go over there. If you guys have any questions, you can either ask it in the chat or just jump in and I'll add you to the chat. But look, the key with options and what everybody has to remember is that options is, and we were talking about this yesterday, it's like riding a bicycle. It's like surfing. It's like one of those sports where you have to, at the end of the day, you got to get on the bike. There's no more, you can't watch videos on YouTube to learn how to ride a bike. It doesn't work that way, right? Consider us your training wheels. You know, people that you trust and are transparent with you and show you the wins and the losses. You know, I show my wins and my losses. It's not all wins. And that's who you have to find, the training wheels. But eventually you're gonna have to hop in, you know, and I think SoFi is probably the best opportunity to hop in. You only need, you know, it's $700, $750. You can actually start wheeling. 750 bucks. And that's why it's important to focus on your returns, because with 750 bucks, if you can consistently generate 1 or 2% a week or whatever your metric is, then why wouldn't you be able to do that with $100,000, $200,000, $1 million, $6 million, $10 million? At that point, your only challenge is just diversifying and finding enough option chains that have the volume that you need, but you capture the idea, and that's the point of it, you know. And that's what we're here for. We're here to hold your hand, and we're here to bring you through it. Let me see if I see any questions on the chat. Anything you guys want me to address? More than happy to do it. Bear with me, guys. I appreciate everybody hopping on. Make sure there was a pretty good segment today with Amit that TJ the Wheel Deal shared. He was talking about Palantir, a lot going on there. Yesterday, we had a really cool chat about what TJ the Wheel Deal is going to do with the holdings from Bitcoin. It seems like we're exploring either a meetup in Miami, 3 cities around the US, New York City, San Diego, maybe Las Vegas, Miami, like-minded individuals, people that are trying to grasp this concept, to use it to snowball their hustle. That's why I named this account this, because options, when you get to the point where options is your main hustle, you've won. You know, you've made it, because like TJ, your goal is to be the CFO of your fund. But for a lot of us that are still generating these funds, this is a side hustle, right? And you have to find a way for it not to hinder your main hustle, right? So you have to get good at it and you have to get efficient at it. And you have to basically develop a sixth sense, if you will. And that's the point of these channels, right? So thank you guys. It's been 48 minutes. I try to keep these to 30 minutes. I know you guys all have your main hustle. I really just want to make sure that I keep tabs on you. You guys keep tabs on me. I'm transparent. We kind of go through this market together. It's going to be turbulent. Not only are we in September, but we have the first rate reduction coming up next week. That in a couple, has it been years already that they've kept it at where it's at right now? Probably. So the market's going to react in very different ways. We have elections, so it's volatile. But guess what? Volatility is good for options traders. That's how we make a lot of our money. If the market was flat, that's not how you make money. There's not a lot of premiums there. So you just have to be diligent. What I intend to do in my next videos is I have a set of rules. So I have about 10 or 15 rules that I've developed over I've been trading now for close to 10 years, right? I graduated from college with a finance degree. I interned at Morgan Stanley back when I was in college. I've been in commercial real estate, has been my main gig now for about 10 years. So it's also very return based, number based, dealing with investors. So I'm very sensitive to numbers, and options, selling options has been one of the most profitable things that I've found. And that's why I want to share with everybody and make sure that it can affect your life too in a positive way. You know, this money, for example, this year alone, you know, we've been able to generate an extra $57,000. You know, I think anybody could use an extra $57,000. You know, had I just taken this money, I think I've put in, let's do the math, 203 minus 57,000. So I put in $140,000. Had I put in $140,000 into the a treasury, you know, a 10-year treasury, or even the 1-year treasury. Actually, I have a lot of my money in 4-week treasuries right now. Treasurydirect.gov is where you buy these treasuries. I have a lot of my funds in short-term bills that just roll over, and I'm getting about 5.2%, I think was the latest return that I got. So assuming that, right, 5.2 return, that means that I would have made about $7,000 on my 140. But instead, with options, we were able to generate 56,000, right? That's close to an 8x or a 7x. So not all years look like this, but that's the game. The game is to try to make them all look like this. So what I'm going to do is next couple videos, I'm going to be incorporating those rules. I'm going to be going over one at a time. So each video is going to have one rule, and I'm going to go and I'm going to dive into that rule, how to use it, how it affects you, how you can use it to protect yourself. Because option trading, while making money is the goal, I think the real goal is capital preservation, is how you keep your money, because you can make 100% or you can make 50% gains in a day, right? I'm sorry, you can make 1 or 2% gains, you know, a week for 2-3 years, but you lose 50% in a day. Then what was the point of you being so diligent over those past couple of weeks? So that's the key, is keeping your money. You have to protect your capital, and you have to always be on the defensive, right? That's really the key of option trading. And especially now, where right now I feel like a lot of people have their expectations, you know, and pardon the swearing, but their expectations are fucked up because they look at Wall Street bets and they look at these random screenshots on social media about how they turned $100 into $1 million in 2 days. And the reality is that it can be done, but the amount of risk that it takes to do that is not worth it. You might as well, truthfully, you might as well put it all on black, and you probably have higher odds in the casino than you do trying those specific trades. So I stay away from that. The point of this channel is consistent income, small, nothing crazy, 0.5%, 1% a week. That is a crazy return if you annualize it. Protect your capital, grow it steadily over time, compound it over time. That's the key of the markets, you know. And it's a lot like, if there's any hikers out here, right? If people that like to hike, go out and climb a mountain. Last month, I just came back from Mount Kilimanjaro in Africa. I climbed for 8 days. And you want to know what surprised me the most of that climb? How, you know, all you're thinking about is your next step, right? One foot after the other. But if you stop and you look down and you see how much you've actually walked, it's absolutely mind blowing, the amount that you can walk. But all you focus on is step after step. And that's how trading should be. A dollar here, a dollar there, a percent here, a percent there. You look back in 6 months, you have 30%, you're up 30% on your account. 30-40%. Right? That's the key. That's how you have to look at it. It's not about sprinting one day. It's about walking every single day. And as long as you continue walking, you're going to look back in 3, 4, 5 months, a year, and you're going to be like, wow, I just beat the S&P 500, which should always be the goal. So anyways, guys, this went over a lot. It's 54 minutes. I really try to keep these 30 minutes in and out, questions, go over whatever the goal of the week is, and call it a day. I don't know if I'm going to be doing a live tomorrow. If I can, I will. I usually try to do on Mondays and Fridays when I open positions and when I close positions. I do some things during the week, but that's pretty much what I do. And so having said that, enjoy your week. I consistently post updates on my X at Snowball on X. So please follow me on there. I would really appreciate it. I answer to all comments. I do have about 2 spots left on the one-on-one. I help friends, family, clients, whoever wants to learn, and whatever level of involvement, we figure it out. If you're looking for that, just go ahead and DM me. And thank you again for watching, and have a great day, guys.